SuperMicro stock has been on a roller coaster. After the first quarter results, the shares dropped by around 40%. Although not all due to the numbers. There was a general sell-off that affected tech stocks in large. Revenue came in below expectations and margins continued to shrink. Forward guidance, however, was positive. But if we zoom out, the full story is a lot more complicated and honestly a lot more interesting. Because yes, SuperMicro has short-term challenges, but at the same time, they have been delivering explosive revenue growth. They are also winning market share and positioning themselves for much bigger opportunities ahead. Let's start with revenue. For the full year 2025, revenue was $22 billion. That is an almost 50% increase over last year. But to really appreciate that, you have to look back at 2022, when their revenue was only $5.2 billion. And then if you fast forward to 2025, it has climbed all the way to 22. So in just 3 years, revenue has grown more than fourfold. That works out to a compound annual growth rate of around 62%. And remember, this isn't a software company where you can scale with a few extra servers. This is a hardware company building real products and shipping physical systems. Management has increased their guidance from 33 to at least 36 billion in revenue for full year 2026. This would mean an increase of around 63% in revenue over last year. Now, one important thing to highlight is that despite this growth, SuperMicro has a track record of overpromising and under-delivering. In Q3 2025, management has guided for a revenue of between 5 and 6 billion, but then they have only delivered 4.6. So they totally missed the target. Then in the fourth quarter, the guidance was between 5.5 and 6.5 billion. The result was 5.8. So this time, they have landed below the midpoint of the range. Now, in the most recent quarter, they have guided for revenue of between 6 and 7 billion dollars. And just 2 weeks before earnings, they have announced that they will miss the target and only deliver 5 billion. And investors hate that, because markets prefer companies that overpromise and underdeliver, not the other way around. This time around, they have said that the revenue got pushed back to the next quarter, as they have gained design wins which will be realized in Q2. For Q2 2026, they forecasted a revenue of between 10 and 11 billion dollars. Over last year, that would be a revenue increase of around 85%. Now, let's move on to market share, because this is an interesting part of the SuperMicro story. Back in 2021, their market share was just 3.5%. But by 2025, SuperMicro claimed a market share of 22%, and their target is to eventually reach 33%. This is significant because it shows that SuperMicro isn't just growing because the overall market is growing. They are actually taking share from competitors. And as the total addressable market for AI infrastructure expands, holding or expanding market share means that the revenue runway is massive. Even if their share stayed flat, they would still benefit from the overall growth of the data center market. But if they continue to grow towards that 33% target, the upside is even greater. Now, here's the problem. Margins. Back in 2023, gross margins were in the range of 17 to 19%, which is pretty healthy for a hardware-focused company. But as revenue started to grow rapidly, margins began to collapse. By the fourth quarter of 2024, margins had dropped to 11.3%, and then in the most recent quarter, they were just 9.5%. On top of that, they have guided for 3% lower margin for Q2 2026. This should be a one-time hit as they have to ramp up production. So that means that the margin should be around 6.5% in the coming quarter. And as a result, their contribution margin will not really increase, although they will potentially almost double their revenue year over year. So in the span of about just 2 years, margins have been cut in half. And that is a huge red flag. Management continues to say that the target margin is around 15%. And yes, if they can climb back up, profitability will look very different. But going from 6.5 or 9.5% back up to 15 is not going to be an overnight process. It is going to take time, likely years, and it depends on executing a higher value product strategy. Now, the key question is, how do they fix the margin problem? Because simply shipping racks of servers to data centers isn't enough. That is a commoditized business. Yes, it drives huge revenue growth, but it is also low margin. To climb back toward healthier margins, SuperMicro is betting on two major areas: DCBBS and their second generation direct liquid cooled systems. DCBBS is a modular end-to-end solution that allows customers to essentially buy an entire data center infrastructure from SuperMicro in one package. Instead of piecing together servers, racks, cooling, and integration separately, customers get a one-stop shop. They have launched this solution earlier in 2025 and expect adoption to ramp up through 2026. Most importantly, they believe that this will be margin accretive. They said that this product should deliver 20% plus in margins, and that is well above the profits they can achieve on the other products and services. Today, these modular systems are just a marginal part of their business, but they are projecting that by Q4, data center building blocks could be 20 to 30% of total revenue. The second pillar is their next generation direct liquid cooled system. This provides a more efficient and cost-effective way to handle that massive heat output of AI infrastructure. After energy, cooling is the biggest limitation in scaling those AI data centers, and liquid cooling is quickly becoming a must-have. Both of these initiatives, modular building blocks and advanced cooling, are designed to push SuperMicro up the value chain. SuperMicro has quadrupled revenue in just 3 years, but the challenge is margins. They have fallen dramatically, and management needs to prove that they can reverse that trend. Guidance misses have hurt credibility, and until the company starts consistently delivering above expectations, investors are going to remain skeptical. That said, the opportunity is still in front of them. If they can hit their 36 billion revenue target and gradually move margins back towards that 15-ish% level, there's definitely upside. The question is, can they execute? Thanks for watching, and please give it a like and subscribe to the channel. See you in the next one. Thank you. Bye.